Hi guys, this is Zach from AZ Money Coach. I just wanted to do a quick video on how to invest in stocks. So basically, most people are already invested in stocks through their 401k plan, but the options are pretty limited in what you can get into. And if you don't have, if your company doesn't offer a 401k, or if you just want more options, you're going to have to open up a brokerage account. So my favorite brokerage account is Vanguard. There's a lot of different options out there. I just like Vanguard because they have the best ETFs and mutual funds with the lowest expense ratio, or the amount of fees they charge per year. And this is the biggest factor into how good an ETF is going to do, or mutual fund is going to do. Another one that I often tell my high school students is ShareBuilder. And the only reason I like that one is because they don't have a minimum balance. Vanguard, you need at least $1,000, where ShareBuilder, they have a $0 minimum balance. So $1,000 is a lot of money for my students. So just to give them some momentum and get started, with good habits, for them, I have them do ShareBuilder. Anyway, so once you open up your brokerage account, you're going to be able to buy any stocks or mutual funds or ETFs that you want. And then you're going to have to be able to choose, what stocks or whatnot you want to buy. I highly recommend not buying individual stocks. And the reason for this is because there's just so many professional investors that are out there right now. So anytime you're buying an individual stock, you're basically, a professional investor is going to end up selling it to you, because over 80% of the transactions are professional investors. So what you're saying when you do that is that you know more than that professional investor who's selling the stock. And they spend all day researching stocks. So it's just not really a good strategy. And also, even professional investors now are doing worse than the average, just because of the transaction costs and taxes and things like that. Because they're competing with each other now, the market prices get pretty much where they should be for how much information we have. Obviously, things come up and some stocks do really well and some stocks do really poorly, but with the information that we have, not knowing the future, we just don't know that kind of information. So we underperform what the average is by trying to outperform. So really the best way to do better than that is to just buy a little bit of everything. And the way you do that is through an index fund. So I highly recommend you get index funds, and you can either get a mutual fund or an ETF that covers that. The other thing you're going to want to look into is asset allocation. So a lot of people thought diversification is just buying different types of stocks, which, if you buy an index fund, you're buying all of them. So you're actually completely diversified as far as that goes. But if you look at, 1 year time periods, and you look at the stock market, even though the stock market's performed amazing, over long periods of time, for short periods of the time, it can have gains of 50%, but it can also have losses of 40-something%. So for a lot of people, imagine if you've saved up $100,000, and it goes down 40% in 1 year. That's $40,000 you lose in just 1 year. That's hard for a lot of people to handle. Think of how long it took you to build up that $40,000 of savings, and then to see it all wiped out in a year, which is why people end up selling at the exact worst time. So when the stocks are the cheapest, on a discount price that you should be buying, you end up selling because, you just don't want to lose anymore. You're scared. You worked your whole life to build up that money, and to see half of it just disappear, it's a difficult thing. So asset allocation allows you to buy different assets. So you could be buying stocks, bonds, real estate, commodities, gold, even foreign stocks will help diversify you. But what you want to look at is you want to try and make it so that when one asset class is going down, your other asset classes go up to compensate for that. So then your overall effect is your whole portfolio doesn't go down, just that one little bit of it. And that completely it reduces your fees a lot. Your losses a lot. You may lose a little bit, but not nearly the 40% that you would have lost if you had all stocks. So the most common asset allocation, Warren Buffett recommended. It was 50% stocks, 50% bonds. Warren Buffett, he's known as the greatest investor in the world. He's the third richest man in the world and made all his money investing. And he says that when he first started, there wasn't so much competition, but now that there's so many professionals out there, he actually recommends just getting an index fund that buys the whole market. And he actually put in a bet with a few of the top hedge funds, these are professional stock pickers, that he could beat them with just an index fund over a 10-year period. And it's like 8 or 9 years into it right now, and he's like crushing them. He's up like 800,000 and they're up like 250. The point being is that just getting an index fund and a bond 50-50, or just keeping your stuff simple is going to do you much more good than trying to get complicated. And the problem, the reason so many people try and get fancy with stuff is that they're getting their advice from financial advisors that recommend them to get fancy so that they can make more transactions and get more fees from them, or so that they can warrant a 1% fee is going to add up to hundreds of thousands of dollars. So to kind of warrant that kind of money, they have to convince people that investing is this very complicated thing, and that that $100,000 or several $100,000 over a long investment time is worth paying to them. And the reality is it's just not. Some other asset allocations, is into bonds. Other than bonds is real estate and commodities, like I was saying. And what you can do is you're going to want to rebalance those as you go. But what it allows you to do is say, bonds go up and stocks go down. Now you can sell off some of your bonds to buy stocks to bring it back to 50-50. And what that allows you to do is it forces you to sell the bonds when they're high and buy the stocks when they're cheap. And then when stocks go up and bonds go down, you can sell the stocks when they're at their highest price and buy bonds when they're at their cheapest price. And so that's a simple version. And the more asset classes you add, the more you can increase your returns and reduce your risks. So one of the portfolios I put in my book in my investment course is has almost no losses. So if you back tested it throughout the history, the worst year it had was down 3%, where stocks, the worst year was down 40-something%. And 50-50 stocks and bonds, the worst was down like 20 or 15%. So by kind of playing around with what percentage of your assets you put in each asset class, you can greatly improve your returns with the same amount of risk, or you can greatly reduce your risk and get similar returns. The downside is you're going to make it more complicated to invest. So, know yourself, know how much time you want to spend on choosing asset classes, and kind of how much time do you want to spend on investing, and choose something that's going to be as simple as simple as you can get it to get the kind of returns you want and spend the amount of time that you want. And I'm going to put some links in the description just so you can get more information. I have an article on my website, and then I have an ebook and a Udemy course that you can check out. And I'll put links to all three of those. Thanks for watching.